Unless you get a warning letter. Well, you go sit down for now. You should take a little bit over. See you at the break.
Yes, I got it.
Jams, Master, sit down for now. You can't play. Jams, this one's going to pass out for a minute here.
Yeah, I know, I'm kind of happy about that.
Any more exams out there? Up there. Benoit, Evan. Giza, Laid. Green throw, needs a drop. Quiet tech, Tyler. Marrero. Patel, Durval. Okay, next exam, and the grades, actually, your exam begins, your break begins on 9th. I will let you know by email if anyone wants to come up and see me. It'll be the 8th or the 9th. We'll have your grades ready. You can come up and see them in my office. Final exam is scheduled for May 9th. Your last class is April, something like April 24th, something like that there. Yeah, April 25th. I think that's your last class. Well, 30th is for the other section. The other section's got the 2 half days, so they get the 30th. So your last class is the 25th. And when's your exam before that? What exam I got before that?
April 4th.
April 4th, okay. Give you guys an option then. Now, May 9th, that's the last day for exams. Anybody like to get out of here before then?
Yes, sir.
Okay, I will ask you next week and probably the week after that. If you want to take the exam early, listen. The problem is getting a room. Don't have any problem if you want to take the exam on April 25th, which means I just got to cover those 3 faster. If you take the exam on April 25th, it will only be on the last 3 chapters. Now, if somebody thinks they're losing out on the money they paid, they're not getting the money's worth, and they want to take it on May 9th, okay, 12 chapters. You got a choice.
That's a no-brainer.
It's a choice.
I'll be here May 9th.
You'll be here May 9th.
April 24th is the evening.
Right there in the class, scheduled class. That scheduled class, because that way I don't have a problem with all of you. All right, wait a minute. You got next week, think about it, because it's all scheduled and everything else. If you want to go that way, we can do it that way.
Well, 12 chapters versus 3, I don't really think there's anything to think about.
You're speaking for everybody. All right, I will let you know who doesn't go along with that, and you can see them in the parking lot. All right. All right, let's go over 8. Where are the questions on 8? What do I do with that thing? 8. Number 1. 8. Who wants it? Come on, no waste I had. Number 1. What? The answer is C. Okay. That's an easy one. You probably won't see things that easy on the exam. But you look at the question. One thing I found out, the other section, people come up to me after class, Turns out they weren't reading everything in the given. You've got a tendency to try to assume what you're being asked and go without reading everything in the given. Costs that remain the same regardless of output levels within the relevant range. This question, that doesn't matter, but you always want to word the question that way. It has to be within the relevant range. Okay, number 2. 2. Go once. Okay.
Variable overhead costs is 161,250 divided by 15,000 units.
Okay, why did you do it that way? What did you do? What's the 161,250?
That is the total budgeted variable overhead cost, and I divided by 15,000 because that is the number of office units.
Budgeted. Okay, that's the key to this thing. Now, you see that problem. You got all this data, you got budgeted, and you got actual. And you were asked for budgeted. So if you start grabbing actual, you're going to get the wrong answer. So an important point is you have to know what is not relevant to the question. Okay, but that's fairly easy. How about number 3? Come on, go ahead. Okay, flexible budget amount for variable manufacturing overhead. So why did you take 22,000 units? Okay, let's ask it this way. Why did you not use 15,000 units? Why did you not use that? Okay, say it louder. You're absolutely correct. Say it louder so everybody else understands. Okay, as soon as they say flexible budget, you're going to use the actual output. Right? Rule. That's it. So, what you need to do on these things, you write down the reasons why. Just don't circle the correct answer. Doesn't do you that much good to say, oh, the correct answer is B. Because you're going to see something similar to this with very different numbers. And then B will be a 1 in 4 chance of being correct. All right, number 4. Who wants it? 4. Which one did you take? Yeah, which answer? B as in Bravo? Okay. Sorry, B, C, D sound the same. That's why I've clarified. Okay. What did you do? All right, let me help out the rest of the people that aren't following this thing. Flexible budget variance. Where is that in your book? What is the formula for flexible budget variance? You want to say a little louder? You all get that? This is the way you get this into your head so you recognize it. When somebody just gives you the numbers and put the numbers in, you explain it. And your best thing to do is you go back to the text. What's the formula for this thing? Because what's going to happen after a while, the stuff's going to start to stick. Then you'll really be a nerd. Okay. 5. Come on. Somebody make the supreme sacrifice. If you don't know the answer, give it a try. You'll learn it better. Go ahead.
Variable manufacturing overhead costs were A, higher than expected for actual output.
How'd you come up with that answer? That's correct.
You have 242,000 actual cost versus 136,500, which is the flexible cost, so it's higher.
Brilliant, right? Would you be surprised under pressure how something like this can cause you headaches? All right, number 6. Number 6. Somebody different, come on. Number 6, going once? Go ahead. No. What's the definition? Pull it out of your book. What's the definition? Variable overhead, flexible budget variance. What's that called? Spending and efficiency. It's not called price, it's called spending. Now, you say, what's the difference between price and spending? What? Oh, wait a minute. Price usually refers to what? Per unit. Spending, called dollar amount. Watch your units. The price is usually a rate. Gasoline is $3.85 a gallon. It's not $3.85, $3.85 a gallon. All right. That one's also too easy to be on the exam. 7. What's 7? Go ahead.
What is the variable overhead flexible value variance? That would be A, 1200 is favorable. I had actual quote 15,800 minus flexible value 18,000. Is that 1200 favorable because the actual is negative?
Okay. Your definition, favorable, unfavorable, is its effect on what? What? Operating income. In this case, since you incurred, actual was less than budgeted, what's the effect on operating income? What's that? You're going to have more operating income favorable. Number 8. Come on, number 8. Going once? Going twice? Okay, it's a volunteer. Makes a supreme sacrifice. Correct. How'd you get that? What's the formula for variable overhead spending variance? Come on, take it out of your book. What's the formula for it? Is what? That's the variable overhead spending variance? So what's the first term you're looking for?
Your actual variable overhead cost.
Actual variable overhead cost was how much? Actual or?
Yes.
What did it say there? You got the right formula? Actual variable, okay, per unit of cost, okay, so we got 1,200 there, which is what? That was favorable. Then what happens? What are you going to subtract from that? What are you subtracting? What's getting subtracted? Budgeted variable, which is how much? Variable manual efficiency. What's the efficiency variance? That's all right. You got to subtract it. What is that? How much is that? What's that? 360 what? Okay. Now, be careful how you say this. What are you doing with the 360 unfavorable? You're adding it to it here. Okay. Listen to my words carefully. The 360 unfavorable. What are you doing to the 360 unfavorable? You're subtracting the unfavorable, which means you're in effect doing what? You're subtracting a negative. So what happens? You're adding. Okay, be very careful when you say you're adding the 360 unfavorable. You wanted adding 360 because you're subtracting 360 unfavorable. Now, that's a pain in the neck, right? You can all agree, yes, but that's a pain in the neck. That's definitely a pain in the neck. But that's life in the fast lane. You want it easy? Who wants it easy? You're all a little bit too greedy to want it easy. Not one of you really would be suitable down there. You get fired in a hurry because you're trying to figure something out. Okay. So your answer is D. All right. Number 9. Number 9. Go ahead, number 9. Okay, how'd you get that? Budget amount is how much? All right, what do you mean budgeted amount? Flexible budget. Okay, get your words straight, because if you have the 2 items listed and you don't have them straight what they mean, there's a good chance you're going to pick the wrong item. All right, correct answer is A there. 10. 10. Nobody wants 10. Go once. Oh, somebody make this. Give it a try. It won't hurt very long. Who's going to laugh at you? Has anybody laughed at anybody yet? Yeah, they're all hiding, laughing under their breath. Okay, number 10. Go once. Okay. No, you've done one already. I need somebody different. Go ahead. How'd you get that? Which is how? The 600 is what? Where'd you get the 600? Question above, which means it's what? What is it from the question above? So say what it is. Now, if you just say question above, you're not going to remember it that well. Just what are you doing there? This, by the way, how you study this stuff. Because you can't give me on a Scantron sheet and say the question above. Okay, go speak. Talk through it. Talk through it. You'll learn it better. What's the 600? Don't tell me the question above. Okay, then what'd you do with that? All right, you subtracted 180 unfavorable. That's what. Don't go say negative. You can learn to say favorable, unfavorable. This stuff is confusing enough without having somebody trying to shortcut it. You subtracted unfavorable. That means you're going to add that amount. Okay. All right, number 11. Number 11. Come on. Go once. Going twice. We skip at number 11. Oh, he's already had one. Got to be somebody different. Somebody different's got it. There you go. That's correct. How'd you get that? 11, the answer is Charlie. Okay, when you do multiple choice, what are we trying to do? Rule out ones you know are wrong. So what can we rule out pretty quick? Okay? Why can you rule out B quickly? Talk about price, so what's the matter with price?
Efficiency variance.
Okay, not associated with the efficiency variance. Rule it out. Now, if you know nothing else, you're down to a 1 in 3 shot. And we know that a few people could definitely use a 1 in 3 shot, right? Okay. What else can we rule out? What's the matter with D? That looks nice. I mean, not really. Don't give me the female talk, the female code. What's the matter with D? What's the matter with D? Say it louder, please. Not relevant to the question. Why not? Denominator level was not accurately determined. If you've got an error in the denominator, which way is your variance going to go? Favorable or unfavorable? What's that? You can't tell. The error could make it go either way. So, what do you do with D? It's not specific. It's not going to answer the question. That gets ruled out. Okay, now you're down to A and C. Now you're down to 50-50. It's a long way to get here for some silly multiple choice question, right? Didn't you see questions like this on the exam? You're going to see something like this on the remaining exams? You better believe it. Okay, what's the matter with A? Unfavorable variable overhead efficiency variance. What are we talking about? We're talking about either what or what? What's that?
Thank you.
What are we talking about? Quantity or quantity? Quantity or what? Price, okay. But it's talking about overhead item. It's an overhead item. That would be a line item, maybe. All right, you notice at the top of the exam, every multiple choice exam you take, it says choose the best answer. Variable overhead item. We're talking about an efficiency variance. It doesn't make too much. You rule that one out, you take C on the rule out. You didn't know the rule. You guys don't look happy. How come? I've given you all these good hints. So you can do better on the next one. All right, number 12. Well, you did one already. Did you do one already? No, guys, somebody different. Come on. 12. Go ahead. How'd you get that? You what? 120,000, that's the static budget amount. That's your answer for the flexible budget amount? All right, did you read the question? What does the question say? Fixed overhead cost allocation rate is $20 per machine hour. The following fixed overhead data pertain to March. What's that? No, A is correct. Why? What do you mean fixed? All right. We've got an actual column and we got a static column. Where does the flexible go? We have an actual column and we got a static column. Where does the flexible go? In between. Oh. All right, what's the rule with fixed overhead costs in static? Same, just move it over to flexible. That's why A is the correct answer. You've got to know that rule. Now, you guys apparently get the same problem a few people in the other section did. Well, how do I know it's fixed overhead? You're laughing, huh? But a lot of other people aren't. How do you know it's fixed overhead? The last sentence of the problem, the following fixed overhead data pertain to March. Oh, we have to read the problem? That would help. CPA exam loves doing things like this. When you guys, especially anybody with above average intelligence, you want to just blow by that question as fast as you can and get to the problem. And you have a tendency to skip over information. It doesn't say anything about where the fixed overhead is. Oh, yes, it does. Right down the street at the Golden Arches. Tells you all about fixed overhead. Well, okay, how many of you did not read that sentence? Be honest to yourself. Okay? Okay. You'll remember, though. You're a little embarrassed, and guess what? You remember a lot better. You know, I'm going to sit here cool like nobody knows anything, and I know everything. You won't remember anything, except how to sit there and look cool. All right. 13. 13. Come on, 13. Oh, here you go. You raise your hand. Go ahead. You can look at the clock if you want. Look where the second hand is. You don't trust the clock, huh? Come on, what are we doing here? All right, let's discuss this a little bit. What are they talking about? Amount of fixed overhead allocated to production. Actual what? What's that? What about the fixed overhead cost? $123,000. How'd you get $123,000? All right, what are we going to start with? Allocate fixed overhead. What does that mean we have to do? You see the word out? What's that? Brilliant. We get a rate. How do we get a rate? Dividing what by what? No, we want our rate. How do we get our rate? What's that? Where do we get our rate from that we're going to allocate? First, static or actual? Okay, static. What is our output going to be? 24,000 units. How much money are we going to allocate over the 24,000 units? $120,000. So what's our rate if we're going to do it by unit? $5 per unit. That's our rate, which we get from the static. What do we do with that rate? All right, allocate, you multiply a rate times what? Actual output, which is what? 25,000. Okay, now who's got these monstrous calculators? $5 per unit times 25,000 units. Your calculator's too small to do that? I don't believe you did it correctly. You need a much larger calculator to do that problem? Okay, how else could you do it? You can do it by hours if you want it. Okay, but here we go. You set your rate up. Why is the rate set up in the static budget? The static budget is done before the period begins. We come up with rates because we got to quote customers. We got to tell a customer, hey, you want this? This is what it's going to cost. We take that rate. Flexible. The only thing that varies is our actual output. Budgeted rate times actual output. Okay, in this case, all you had was fixed overhead costs, which that tended to confuse some of you. Suppose we had fixed and variable in there. Oh, you'd all have gray hair before the exam was over. All right, number 13. 13, go ahead. Oh, that was 13. Number 14. Go ahead. Oh, wait a minute. Let me see. You took the actual cost, which was how much, subtracted, which was what? And it gives you 3,000 unfavorable. Man, that was terribly hard, huh? Okay. If you know what you're doing, it's that simple. If you don't know what you're doing, you're kind of hopeless. You just got to know it. 15. B, Bravo. No, excuse me, C, Charlie.
What do you take the actual
What's it saying? Fixed overhead spending variance. What's the definition of spending variance? What'd you say in the book? Look it up in the book and work it from there. Okay, 15. What's 15? Is any of this sinking in any better? You know how to study for it better, I hope. 15. Come on, let's go. 15. Go ahead, you got it. 15. Well, tell me, read the problem, tell me something. And you say, and you got that how? By looking at the clock or what? No, it's not A. A is incorrect. What do you have to do? First, you look in your book for the production volume variance. What do we know about that word, production volume, or those two words? We're dealing with what? Quantity, but variable or fixed? Fixed? In top production, we're dealing with fixed. Okay, that's a word we got for that there. Okay. So what do you have to do? First thing we're going to take, we're going to subtract something from what? Actual from the budgeted, okay? Or we take the budget from the actual, but we have to watch our signs. So what are we going to get? We're budgeted how much? 120. And what was the actual? How much fixed overhead down? We can't say actual here. This is where I should not have used that word. Your overhead is allocated based on the actual, your actual base. So how much was allocated? 125. So what does that do? Why favorable? Why not unfavorable? Okay, an allocation. This is where it starts to get really tricky. An allocation. What did I say is the definition of an allocation? You don't remember. What? A what? An allocation. What's an allocation? Counting fiction, which means what? Never really happened. Okay. So we got $125,000 allocated. It didn't happen, really. That's not incurred. What happens is that $125,000 got billed to a customer. So what happens if we bill a customer $125,000 and we only had $120,000 expenses? What's that? Yeah, aside from maybe a little ethical dilemma, we got favorable. Now, this happens, and hopefully it's a small amount. You either wind up allocating a little bit too much or a little bit too little. That's business. That's called your bearage. You're going to get it one way or the other. You just hope it is not too much one way or the other. Yes. 25,000. Where does that come from? 25,000 is the actual units produced. All right? So we're going to take the rate times the actual units produced. Your rate is how much per unit? $5 per unit. We're going to allocate $5 per unit for every unit produced. All right, now, this is the concept. When we did the budget, we figured we're only going to produce 20,000 units. December 2011, that's what we thought. You go through 2012, and you find out we produced 25,000 units. We're going to allocate more to be billed. We built more. We're not going to give them away for free, are we? Unless you're the federal government. Okay? Then you get things away for free. With business, you got to charge for it. Now, what happens in the opposite case? You only sold 15,000. You call the customer up and say, oh, look, customer, we had a bad year. I got to give you an increased bill. How far are you going to get with the customer on that? You're not. You've got it agreed to in the contract in the first place. Now, that's when this thing gets to be very critical. You want to be as accurate as you can. Now, over the last couple of years, what's happened to a lot of companies? Didn't matter how accurate they tried to be, the economy was so wacky that a lot of them got caught up short. All right, 15. What about 16? 16. Where's that? Did I not have you 16 on that thing? 15? You guys still can't figure it out? 15D, Delta. 5,000, favorable. Why is it favorable? Okay. It didn't happen. What do we mean it didn't happen? You're not going to find that in the book. That's my way of explaining it. It didn't happen. You didn't incur those costs. You allocated 5,000 more than you incurred. Is that bad? Well, it all depends. If you wind up selling a lot more than what you figured on selling, you're entitled to make the profit on it, because the opposite is if you sell less, you're out money. You're going bankrupt. Why is it not actual minus budget? We're doing a calculation like that to come up with the amount of favorable. We allocated. How much did we allocate? We allocated 125, what was budgeted. Okay, but don't put the word actual in there, because we allocated. Allocated puts you where? When we say the word allocated, what are we talking about? An overhead rate? So if you see the word allocated in question, you talk about an overhead rate. All right, 16, or is that it? Oh, 16, yeah, I got 16. Come on, 16. Here's a journal entry type thing.
C.
What? Why do you say that? Which one did you pick? D is a delta, that's correct. Why?
Because you have to, because that's the account that you use to put your,
All right, first of all, we approach something like this. Let's try and group our answers. A and B deal with $150,000. C and D deal with $133,000. Do we know which one is correct?
well, you're not going to put entry.
What's the rule with standard costs? Standard cost, you're going to record what? What actually happened. You're going to record the standard. Okay? So the standard. Now, Curtin uses the standard cost list, $133,000 very manufacturer overhead costs were incurred. Flexible budget was $150. What does the flexible budget amount mean? What? Tell me more than that. Flexible, yes, it did. We took the actual produced times what? The budgeted rate. Okay? That's what flexible means. All right, we're talking standard system. What do we got? We have rates for just about everything. That's why standard systems are a pain in the neck. But in this case, because it's standard system, the 133 is going to be the correct answer. What does that do to A and B? It can't be. When you see something like this, try to rule two of them out. All right, let's take it the other way. What would the entry be? But not the numbers, the written entry. Variable manufacturing overhead. Which of the following manufacturing overhead entries? Variable manufacturing overhead cost. Which one is most likely to be the correct answer there? Look at the question. March, $133,000 of variable manufacturing overhead costs. What's going to be the title of that entry, most likely? Variable manufacturing overhead control. How many have that kind of entry? How many of these entries have that title? One's really got the control account there. So if you do that, you can eliminate that. But if you didn't work too up on the control, well, it's got to be variable manufacturing overhead. Why can't it be accounts payable?
You owe the money.
You know yourself. So you can actually, A, you can look at that. A can't be the answer. Oh, I forgot. You guys didn't take financial accounting, right? You know, nobody's contradicting me. Why don't you guys know this that well? You haven't had enough repetition. Oh, maybe some of you didn't read the book. Another possibility. Even those who did read the book, you need more repetition. Okay. So we can work it this way. Anytime you got one of these multiple choice, if you don't know the answer, you're not familiar with it, take what little you do know and try to rule out something. If you can rule out 2, you're doing good. What's 2 going to do for you if you can rule out 2? You'd have 20. Where would you be at 20? So what does it tell me about some of these scores? Somebody knows a little bit more than nothing. Several somebodies. Okay. All right, let's get on. We want to get through 9, start 13. Okay. Inventory. Costing. Inventory. What's significant about inventory? Come on, what's significant about inventory? Why are we even paying attention to inventory? First of all, what financial statement does inventory appear on? Balance sheet as asset. Oh. And how interesting is that? Why? Okay, also, if you are in a precarious financial position and you want to cook the books, one way to make your financial position look better is to increase the inventory amount. One thing about the inventory, it doesn't complain. So this comes to be an area where once you get into auditing, you spend some time in there. You want to make sure this is correct because that inventory, what's our big problem we're trying to do with the balance sheet? Number one thing we want to make sure we have. We want to make sure the current assets are at least equal to the current liabilities. What happens if your current liabilities exceed your current assets? What's that? Worse than not good. What's the word? Insolvent. Inventory is a current asset. So if somebody's got trouble, like many companies have had the past couple of years, and your bills, you can't keep up with your bills, but you want to fool a banker or an auditor, inventory is a pretty good place. One of the most common. Inventory is going to involve all of the variances and costs and numbers. It's such a pain in the neck, people don't want to look at it. And if you're going to run a scam, you're going to pick a place where everybody wants to look, or you can pick a place where nobody wants to look. What? Ah, you got potential, young lady. Capacity analysis. What's capacity referred to? What's that? Whatever kind of capacity we want to talk about, what does it refer to? How many seats in this room? How many seats in this room? 58. Don't have it so much in the spring, but in the fall, Oh, can I get this? I want to be in the party. I want to be too. Whatever it is here. I'll sit in the aisle. No, you won't sit in the aisle. You won't sit in the aisle because if you do sit in the aisle and the fire department comes along, they give me a $500 fine. I don't know if I'm ever doing that. No, out. Okay, capacity. How much can we put in the room? What's the capacity of Rutgers? What is the capacity of a refinery? What's the capacity of an airliner? So many seats on the airliner? Do they carry more passengers than that? You ever been on an airliner where somebody was standing in the aisle? No. A bus, maybe. Airline, no. Have you ever ridden the New York subways? You ever gotten a seat on the New York subways? We try to rush hour, huh? That's always good. Every once in a while, I usually get down there at the end when the door is there. You can see people hanging on, and you can watch the rush of hands as loading, unloading. There's invariably there's somebody at the door hanging on, and you can see his hand hanging on as his body is going towards the door, and all of a sudden it lets go and he's swept out the door. It's not just stop, don't stand near the door. Okay, absorption costing. Oh, isn't this a fun word? Look at all the excited faces out here. I could just feel the excitement. Product cost or capitalized, period cost or expense. What the world are they talking about? Oh, I forgot. I'm sorry. I apologize. You guys didn't have your course in financial accounting or managerial accounting or any other kind of accounting. What are they talking about? Capitalized expense. What's the distinction? You expense something, which financial statement? Income statement. You capitalize something, which financial statement? Balance sheet. Are we going to expense inventory? Yes. Why do you say yes? We're going to transfer it. That's a little tricky question there. You don't put inventory as an expense item on there. Cost of goods sold, different story there, though. Once we put it into inventory, we got to take it out. Actually, once it gets into inventory, where does it go? We make all these things, we make all these widgets, we put them into inventory. Where do they go from there? Out where? Out for a walk, what? Shipped to a customer. Actually sold when shipped. Shipped to a customer. What kind of transaction do we have when we ship something to a customer? What's that? Revenue. We get revenues. What else? Card call. What else? What else? Inventory sitting on the balance sheet. When you sell it, is it still on the balance sheet? What happens? Reduced, and then what? Expense. Oh, I want to bring a bunch of accountants. Soon as that inventory gets put on the UPS truck, accounts receivable, brilliant. We exchange assets. We exchange this asset for an accounts receivable asset. So this is why we're going to have to keep track of these things as assets. They get sold, get shipped, unless we get cash. In which case, what do we have if we get cash? We get cash as an asset. Revenues goes where? Income statement. Okay, that's where we're going to figure out our operating income. What's going on in the balance sheet? We just take this stuff. If we got $1,000 here, we set it there. We get $1,000 accounts receivable. What happens? What's the change in the balance sheet? There is no change until when? You get the money received, the accounts receivable gets zeroed out, and we pick up cash. You take accounts receivable for $1,000 and you get $1,100 in cash. How are you going to figure it? That doesn't change things. What finally changes the balance sheet? What? Closing entries are what? You close out net income from where? From the income statement to where? To the retained earnings. Okay, under what? Owner's equity, right? Okay. So it sits in there with owner's equity, retained earnings, that goes on the balance sheet, and that's the way we make out. In the meantime, our inventory, though, this gets exchanged straight up for either cash or accounts receivable. All right. Product costs are capitalized. Going where? No, balance sheet has what? What kind of asset? Inventory. Hey, brilliant. Period cost. What's a period cost? Besides the cost of the period. When they talk about period, see period cost, what you compute? What's financial statement we're talking about? Income statement, that's what you should immediately compute. And those who don't immediately compute that, start immediately computing that. Period cost, income statement. Go home, smack your head against the wall 8 times, and say, period cost is income statement. Don't think about it. React to it. Expensed. We're putting them on income statement as an expense. And the period, it gets closed out to where? The balance sheet. Variable costing. Variable product and period costs are capitalized. But fixed cost, period costs are expensed. Getting confusing? Yes, it's just getting confusing. Throughput costing. We got 3 types: absorption, variable, throughput. Isn't that fun? How come nobody's smiling? You don't think this is fun? Oh, well. Neither does anybody else. So there's nothing wrong with you. Only direct materials are capitalized. All other costs are expensed. What's interesting about this? When we talk about direct materials, what should immediately pop into your head that goes along with direct materials? Direct labor. What's going on with the direct labor in this costing system? Being expensed. Only direct materials. Otherwise, people start looking at this thing here, and they just start taking all the overhead expenses. And they don't look at direct labor. Only direct materials. Everything else are expensed. All right, variable costing is a method of inventory costing in which only variable manufacturing costs. All right, now what other kind of manufacturing costs do we have besides variable? Fixed. Okay. Absorption costing. All variable manufacturing costs and all fixed manufacturing costs are included in inventoriable costs. All variable and all fixed. Which one sounds like more fun? Neither one of them sound like fun, right? They're both a great big pain in the ass, right? I think that's okay. They are. Differences in income. Well, why do I keep telling you this is a pain in the ass? See, if you get that ingrained in the back of your head when you start to study, you say, well, wait a minute, he's already told us this is a pain in the ass, so why don't I just forget that and move on and study? That sound like a logical thing for me to do? Otherwise, you're going to sit there and waste all kinds of study time arguing whether or not this is a pain in the ass. Now you're not going to waste any time arguing that, are you? Been established as fact. But, knowing you guys, here's somebody who will argue. All right, differences in income. Operating, oh, what does this mean? What's that? Yeah, that's true. All right, operating income. What should we think about when we hear operating income? Income statement, okay. There's the last item on the income statement, operating income. What's the last item on the income statement? Net income. What's the relationship between operating income and net income? You got a lot of overhead expenses in between the two. Operating income. Companies like to look at operating income. If you think in terms of automobile companies, any of you familiar with the car that GM used to make, the Pontiac? Okay. What GM would do is they'd have each one of these divisions, they keep track of the operating income for each one of the automobile lines because they wanted to see how each one was doing. Pontiac is a good car, just wasn't selling enough. Drop it. This is why they use operating income. What will be put onto the operating income per division is you're going to get that corporate allocation. President's chunk of his salary, everybody up there. That all gets put on to come up with your net income, the total cost to come up with net income. But when we want to see how a product is doing, we're focusing on operating income. What does Rutgers use for operating income here? What do they use? They get their go, no-go number for each course. I don't know what it is for this course. I don't recall them ever having insufficient students for spring and fall course. During the summer, I think they want 12, something like that. If they go less than 12, then they cancel the course. But that's what they use it for. They're not making enough. They're making plenty of money. Whereas Rutgers losing money? Not in the classroom. I'm not getting paid anywhere near the amount of money you guys paid to be here. Get it down to 25 of you, I'd still get paid the same amount. So why don't about 20 of you withdraw? How about it? That's how they really make it out. Okay, the amount of difference represents the amount of fixed product cost capitalized as inventory under absorption costing and expenses period cost under variable cost. Okay. We still got the costs. It's where we put them on the financial statements. You may use either method. Not a problem. Oh, the problem comes in when you decide to change methods. Changing methods can be completely legal, as long as you disclose and show the impact of the change. Now, showing the impact of the change, that's what some people don't like to do. It was this way. Had we kept doing it this way, we would have had this much. But we shifted to this, we got this much. If it's presented that way, fine. That's the way it's supposed to be presented. All right, what do we got here? Oh, come on. You're allowed to read the title of the slide. What do we have here? Comparative income statement between variable costing and absorption. Okay. Top line. What is it? Row number 2 on the Excel spreadsheet. What is it? Revenues. How come they're the same? Because what? All right, we got a costing method. It's not a revenue method. It's a costing method. All right, so sneaky CPA exams may leave this blank. What would you have to do? What? It has to be the same. If they give you this one, that one's got to be this one. If I give it to you that way, you put your hand up, Professor, it doesn't show what the revenues is over here. Oh, you want no revenues right down to golden arches. You got to know what the rule is. That doesn't change. Okay. Beginning inventory. 0 and 0. All right. Sometimes you'll find that blank. How do we know what the beginning inventory is? Read the problem. New business started January 1st, 2012. What's beginning inventory? Zero. You'd be surprised how many people looking all over the place for the beginning inventory. What's that amount? Okay. Variable manufacturing costs. Variables are the same. What's going on here? What do we notice? What's that? What do you notice? They're the same. Everything the same? What's different? What's that? No, wait, let's just look at this line here. How many units? You see a problem with that? Revenues, how many units? Well, how can you have 6,000 units of revenues and 8,000 for manufacturing? We got 2,000 units we made more than we sold. Where are they? Inventory probably, someplace. We got to account for them. So you look at that, there's 2,000 units that have to be accounted for. All right, next line. Allocated fixed manufacturing costs. That's a definition of absorption cost. They're going here. How much per unit? 135, you got to be given that, or something to calculate it. All right. Cost of goods available for sale. Cost of goods available for sale. 1,006,000, 2,680,000. This method, we have more dollar value of goods for sale. If you don't know anything what's going on, you can be fooled by that. This is the method they chose. Fine, if that's your method. Okay. Deduct the inventory. Only when some company's going to switch. Companies change once in a while. They want to change their method. In which case, that's where you're going to have to take the books out and find out did they do this thing exactly right. But this is a comparison. When somebody wants to do something, you'll see that with some companies. Why don't we change methods? What's it going to get you? A lot of companies stay with the one method because so once you count the numbers differently, you're still going to come out with the same net income. All right, see here. What we got here? Ending inventory. Where we get the 2,000 units from? That's a leftover. And how much money? $200. Okay, how about here? Ending inventory. At how much money? That you got to add these two. Ooh, how many people would forget to add those two? Yes. No, don't say always, because you could have adverse conditions which costs would be lower. Okay, but usually. All right. The marketing costs, $185. What are they talking about there? Variable marketing costs. That's your marketing department, whatever it is, whatever those costs are. But we look at $185 per unit times units sold, and over here, that has to be the same. It's going to be the same number. All right. Contribution margin. $3 million and change. Over here we got a gross margin. Uh-oh. Different words. Different words because we're on a different method. Now what are you going to have to do? Like it or not, you're going to have to do a little bit of memorization there. Which words go for which method. All right. Fixed manufacturing costs. $1,080,000. Fixed manufacturing cost, fixed marketing costs. You get fixed marketing here. They've broken it down. That's where they've done some changes there. So, operating income, $1,200,000. Operating income, $1,500,000. But we're not done. We could just say operating income right there. That's what we want to measure, as long as we specify which income. And any accountant knows, you hear operating income, we have to take some more expenses from that. Fine, operating income all night long. We got to take more expenses to get the net income. Where you make a mistake is all of a sudden somebody writes net income. That's a big mistake. All right. 3 years, income statements. Oh, man. So what do we got here? All the same titles. Panel A, Panel B. What's going on this way? What's going on this way? Read the titles. What's going on this way? What do you got here? Where's 12, 2013, 2014? How can we do that? Assuming we're at December 31st, 2012, where are we getting 2013 and 2014 numbers from? And they should be labeled, budgeted. A couple of years from now, when it's December 31st, 2014, we got all actuals. All right. Once you do things like this, this is called horizontal analysis in the audit world. You'll be doing a lot of that, which is really just slightly modified this comparative analysis. You don't do this in the audit world, you're liable for lawsuit. So it comes back to this. And actually what's going to happen is in the audit world, you pick on something that's jumping around too much and then go down and look at that. That's how you'd use this. All right, tell you what, why don't you take 10 minutes and get back here and we will get going. I'll try to have you out here a few minutes early. As long as we get done with this, get the next one started. Those of you who didn't get your exams, get up here. Bring around here, bring your IDs. I know who I'm talking to. Take about a minute, give me that exam back. You can have the sheet. Monday, I'm going to be in tomorrow morning. Are you around tomorrow morning? Probably at about 9 o'clock. 9? I got a meeting at 10:30, so as soon as the people start coming to the meeting, I'll be talking to them. But you try to get in about 9:30. Up to 9:22. Okay. You don't get a letter grade right now. I want the exam back, you keep this score sheet. How far are you from the average? Above or below? You'll see or worse. April 19th is the next one. April 19th, that's unless I come up with something else here. Wait. You get your score sheet out of here? Okay. Not this weekend.
No, I mean like in general.
Maybe. I gotta get somebody to come in. I gotta get somebody to come in. Yeah, you know, somebody give up a Saturday?
I do. I would.
No. I gotta get a professional who gets paid $300 an hour to come in on Saturday, and then I gotta do him a favor. Not easy to set up.
April 19th in September.
That's the next board examiner's dinner.
Okay.
Right? You keep that, yes. What's that? No, that's your version of the exam. There's your number grade there. Very good. See up there? Are you above average or below average? You should have been here earlier. Oh, you guys that came in late, did you get the handouts? I will say, well, why don't you have an ID card? That doesn't sound right at all. Somebody's playing games. But you paid for the course. You gotta watch out, they'll have to drop you from the course. But you got a 30. So about the only reason why I give it, because you did good there. Good, just start 13. Why are you going to leave? Let me note down there. Leaving only because of sick wife. When do you want to leave? Now? Write a note down there, right opposite your name. Yeah. What, you don't like me anymore? What? So what's your problem? This one class, this one's no problem. Everybody's allowed in this one. This one, I don't care, for whatever reason. For those student things, you can go to the other events that I have. For student ones, get your quarter letter grade. If you want more than that, you got to go to someplace else. Next one is April 19th, for executive meeting. Okay, let's get moving here. Any other exams out there? Wait, you keep this. Who else got their exam? Better get up here. Okay. Comparisons. All right. Basic matrix. Variable costing versus absorption costing. Fixed cost, is there production volume variance? Production volume, we know we're talking about fixed cost. Got two in here. Same thing. How do they affect inventory? Okay. Here is where people can make changes in the method because income of comparative income effects will be higher. But if you're going to make a change like that, you got to state, disclose, we're making a change, and this is the effect. And the effect usually is you present the old method and you present the new method. If you do it that way, you're completely legal. But you're not going to fool anybody. If you want to fool somebody, you just skip that. All right, unit level sales, variable costing. Now, absorption costing. Because we got more drivers, you get a little more precise on costing. That's why a lot of companies prefer it. But it means more work. And that's why a lot of companies don't like it. Just do the shortcut. We don't need something that precise. All right, variable direct manufacturing cost. Variable direct, what are they referring to? Variable direct, what are they referring to? What are they referring to? Direct labor, direct material. That's variable direct. Why is it called variable? So many hours of labor to produce a unit. That is your direct labor rate. You need so much material per unit. That's your direct material. So we talk about variable direct manufacturing cost, how much per unit. If we just said direct manufacturing cost, what would we be looking for? Total direct labor, total direct material. Variable, we want to get down to a rate. Oh, you got to know these words? No, you don't know these words. Down the street, golden arches. No problem. What do you have to know there? Very limited vocabulary, right? And number one, Happy Meal. Number two, Happy Meal. Number three, Happy Meal. Supersize the fries for your girlfriend's birthday, whatever. You girls aren't impressed with that. How come? What's that? Actually, if you're the manager of one of these, you make good money. Yeah. Yes. That's right. They got good benefits, but working at McDonald's manager level, of course, you got to decide how many people to have in at what time. You just don't have a bunch of people that work 40 hours a week. You got 6 hours, you got 8, you got 12, you got 14. This is the time I want you in. This is what the manager does down there. I think the manager here in Newark makes $100,000. When is it open? When is it open? You're responsible for the whole operation. You may not be there every hour, but you're sure going to be there a lot of them. What happens if you're not there? What happens if you're not there? You better have a good assistant or you'll get stolen blind. All right, variable indirect manufacturing cost. So indirect, what are we talking about now? What's some examples? What's that? Examples of it is what, for instance? Electricity is one, a lot of things like that there. Okay. Watch your words. Are we looking for variable indirect, variable direct? When you get the problem, read the problem. Which one are you being asked for? Oh, we got to read that? No, you don't have to read it. Right down the street, okay? All right, actual costing, normal costing, standard costing. Standard costing has got some peculiar rules. We have a standard cost rate for what? Material and labor. Some even have standard cost rates for overheads. All right, variable indirect manufacturing. Again, we look at this. We got our actual budgeted and the standard. Remember, when you look at standard, standard is a separate beast. Why would a company want to mess around with standard costs? When you're giving a quote to a customer, it's much easier for the people preparing the quote to just go in and say, all right, here's our standard quote for this type of labor, for this type, this is the hours we do for it here, boom, here's your quote. That's why companies like that. They can give a quote quickly, and they can be consistent with the quote. So if the customer comes back and says, well, yeah, I like that, but I want to increase the quantity from 500 to 575. You're using the standard cost system, it's very easy for you to modify that. Makes the customer feel pretty good. They tend to do business with you. If you forever, well, you know, it's going to take me a while to figure this out, guess what? That customer's going down to somebody else. So a lot of these things are done to do business with the customer. They're not done to make life easy for accountants, okay? So if any of you are expecting that, forget it. Who do you want to make life easy for? Customer. That's it. Make your employees working to death as long as the customer's happy, right? All right, alternative inventory costing system, fixed direct manufacturing costs. We can have some fixed direct manufacturing costs. And again, we look at again, actual costing, normal and standard. Indirect manufacturing costs. So we got variable, direct, indirect. We got fixed, direct, indirect. How's that for confusion? Getting up there, right? Very similar set of formulas. All right. Managers may seek to manipulate income by producing too many units. Well, now how can you do that? How do you do that? What happened on the one problem we had? One from your 8 handout. The allocation, where more units were produced than were budgeted, what happened? You allocated more than what you actually incurred. Not illegal. Starts getting too far out of whack, different story. Unless you're doing that intentionally. Now, if those 25,000 units in the prior problem were sold to customers, well, that's just great business. What they're talking about here is, let's build an extra 5,000 units and put them on the shelf. Inventory on the balance sheet. What effect does that have? We got inventory we're not going to sell. It's propping up our assets. Would people do something like that? I guess they would. At least they got real inventory. But that's one way of doing it. Some companies will do that so they don't have to lay off workers. So if we budgeted 20,000 units, but times are tough, they're not buying. The customers only want 15,000 units. What do I do? Lay off 25% of my workforce? Some companies say, wait a minute, we'll build the units, keep them employed, and let's keep our fingers crossed and hope the economy turns around. That's called gambling. Legal, that's a legal gamble. And then want to lay the people off, we wind up with this excess stuff here. Production demand will increase the amount of inventory on hand. Well, obviously, unless you sell it. Who doesn't have a problem with production beyond demand? What? Yeah, right now Apple's doing really good. A couple of years ago, Apple's having a problem, but they can't build enough of them things, right? Yeah. What does that do for China? Where they made? Where they made? Don't tell me Newark. Where are those things made? And all those people that work? What's that? Oh, well, would you buy one then? What? A lot of people don't agree with you. They're buying them. But Apple's making plenty of money. Anybody screaming at Apple, you naughty company, you shouldn't be making money? Anybody screaming at Apple for that? No, I want to be able to buy one. Don't worry about that. Okay. Increase the amount of inventory on hand. Now, a lot of companies do this. They deliberately plan to have an excess. But these are planned excesses. What about the refining industry with gasoline? Any excess there? There is. Where? Where's the excess? The amount they hold? They're doing just great now, selling everything. Price is going up. Why is price going up? There's too much demand. Where's this demand coming from? Yeah, China. You ain't people making money, making this crap for us? They're getting paid. What are they doing? They're buying cars. Now they need gasoline to run the cars. Where are they going to get it from? Oh, back to us. To make it feel good? You're smiling. How come? Look, it's a global economy. Do you want a best example of a global economy? Look around this room. How many of you are not from the United States of America? How many? What are you doing here? You have a choice. You're here. So we said only United States of America citizens could be here. What would happen to Rutgers? Boom. Half of them be gone. It's a global economy. Get used to it. You can't sit here and bitch and moan about some other country doing it. It's a global economy. Get used to it. All right. More fixed costs being capitalized as inventory. Okay. And once we exceed our fixed costs that we've incurred, do we stop capitalizing? No, we don't. We've got that money in there. There might be a problem later on, but right now that's how it's done. And if we don't build enough, what happens to our fixed costs that we couldn't capitalize? They're sitting there, they did not get allocated. We got a nice, even bigger problem. All right, smaller amount of fixed costs to be expensed during a period. Profit increases. Go to manager's bonus. What's this got to do with anything? Manager's bonus has got an awful lot to do with a lot of things, but companies don't like to advertise this too much. Anybody know what the audit committee is in the company? You've heard of an audit committee? What do you think the audit committee does? They get the auditor. They don't do the audit, they get the auditors. Anybody ever heard of a compensation committee? Now, where have you heard of the compensation committee? In charge of coming up with what the CEO and those guys make. They make the deal with the CEO. You start looking for a compensation committee in an audit textbook. I can find it there. They're not supposed to be teaching you guys that stuff. Why not? Manager's bonus, that's about us. We don't want you poking at the CEO's bonus. Oh, when I say we, that's the people who run McGraw-Hill, Pearson, the rest of them. They don't want you auditing the CEO's bonus. Oh, yeah, the manager of the shop floor, yeah, you can audit his bonus. You take auditing with me, I'll tell you a lot of things like that they don't want you to know. Yes?
So,
Okay, you want to get to ethics. First of all, we're going to have to understand what the system does. A lot of companies, they have, manager just doesn't up and order something made. The order's coming down from higher up, make so many units, and the manager has that order, and he can go ahead. If you have something like this, it's very difficult for a manager to manipulate. The order's got to come down from higher up. So you want to look at this. Who's got the order to say this? In some companies, if they just leave it up to the manager, and there's no procedure, and the manager says, well, in order for me to get my bonus, we have to crank out more units, which is what went on in the car industry in the 50s, where we have to crank out so many units, don't worry about the quality. What happened then? These guys had to make, they made a bonus, the units got produced. And what happened? What's that? Yeah, quality went down. Okay, so what? Then what happened? What's that? Well, we had the oil crunch in there. That allowed those little Japanese cars to get going in here. Then what happened? Out of desperation, because people couldn't afford the high gas prices, they bought these smaller cars. And lo and behold, what did they find out? Better quality. It didn't happen in 1 year. It took about 10 years. Because somebody's got to buy it. It's a great car. I don't believe you. Let me try one. Then after a while, enough people are out there. All right, so that's got to be looked at. What are the rules of the game? And that's one big thing a lot of auditors fall short on. They just see something right away, problem. You got to look through what's the rules of the game. What does this company allow and not allow? One big reason is we got the manager who wants to build whatever he wants to build. They got parts that go to this thing. Something's got to be ordered. The purchasing manager has got to be given the authority to order raw materials. And you usually don't have the floor manager with that authority. Unless you got something going on. You're getting into a deep subject. Because you got to understand what's going on in the company. All right. One way to prevent unnecessary buildup of inventory for bonus purposes, base the manager's bonus on profit calculated using variable costing. Okay. They calculate the profit, and this is how we can tell. Look, you built this stuff, it's in inventory, but profit is coming from where? Which financial? What's that? Income statement. If you build up the inventory, where's that going? Balance sheet. So we want to see the profit on the income statement. You've expensed all this stuff. Where's the sales? Complicated system producing two inventory figures, one for external reporting and the other for bonus calculations. Okay, like it or not, this is what goes on. Sometimes it gets more complicated. They get down to that bonus. It's nice to talk about it here, but it's even better to talk about it in nice big financial houses, banks. How do they figure their bonuses? How do you figure a bonus of somebody that moves around mortgages on houses? What's that? Pipeline, what does that mean? Amount of mortgages, dollar amount of mortgages they process. I got 10 million in mortgages approved. I get my bonus. What's that? No, we're talking about the financial houses. They move it through. Oh, wait a minute. You're talking about the company. Fine. Move out of the company. What happens to mortgages after they leave, after the mortgage company? They get sold. What do you mean sold? All right, okay, let's start at the beginning. We get a mortgage company. Let's say the mortgage company's got $10 million of cash, and they loan it out, $10 million of mortgages. Now, at that point, if all the cash is out and they're holding all these mortgages, the mortgage company's really going to do no more business except collect interest. All right, okay. If they didn't sell them, that's all they could do. Okay. So we come up with this thing here. Wait a minute. Since you got all these people who are selling mortgages, but you can't sell them because you don't have any cash, why don't we buy the mortgages from you and get your cash? How's that sound? Well, why would somebody want to buy mortgages? What's that? And that why? All right, what does a mortgage carry with it that an investor's interested in? Interest. You get an interest payment on this thing. And so we'll find out whatever it is. Okay, I'll pay you a little bit less than it's worth, so I make money on it, or I get the interest. Now, you said bundling. Yeah, what does that mean? A little bundle is the problem? Come on, what are you talking? What is a bundle? What does it mean, bundle? Okay, wait, okay. Speed things up. The loans, they know that there's some that are more risky than others. So the bundle would usually include something like 10% risky, 90% very low risk. And then what we would do, we got this bundle, millions worth, we'd sell you 1%, sell you 1%, sell you 1%, 1%, so split it up all over the place. That way nobody has got too much risk. So we get that, the cash goes back to the mortgage company can loan out more for houses. All right, so what's the problem the mortgage company eventually runs into? Sooner or later, you're going to exhaust the pool of qualified buyers. But these guys that are marketing the mortgages, every time they take a bundle and it processes by somebody's desk, he gets a bonus paid about the amount of dollars he processed. So what's going to happen? But we've already got everybody that's qualified. What? My God, you can't say things like that. How dare you say such a thing like that? We lower the standards for qualification. No, they're qualified. We just lowered the standards. And now what happens? So we get that whole bunch in here, and we're going to market them out. Now we're sitting like 20% risky, 80% not risky. We'll go get some more. Well, we've exhausted it. Okay, and we're getting down to something like 50-50. You're pushing people in there who really they should not have given loans to. No, it isn't ended yet. Okay, now we come up with something. We've got, if you are any kind of firm with a piece of a bundle or a piece of several bundles, where are they going to be carried on your financials? What's that? Assets, okay. Now, since these assets can go bad once people default, we refer to those assets as toxic assets. That's what that means. Don't worry, you won't get tested on that. That's a freebie. That's what the term toxic, and now how many of those are out there? Don't say a lot. You could think of every time you got the bundle was split up pretty much 1% to various buyers. So some of these companies got 1% of maybe 50 or 100 bundles. 1% of each bundle. How many of them are going to go bad? They don't know. The extent of this right now, who knows? But the whole thing was motivated by every time somebody processes a bundle, your bonus is based upon the amount of dollars you process. More? Now that's like the more students I pass, the more money they give me. That's never going to happen. I get one flat amount, no matter how many I fail. Right? It don't make you feel good, does it? Too bad. Okay. Manipulation schemes. Now, they like to call them manipulation schemes in here. Manipulation would be as opposed to out-and-out fraud. You can do a certain amount of manipulation within a company without crossing the line. Certain amount. Management shouldn't tolerate it, they can fire you. All right, decide to manufacture projects that absorb the highest amount of fixed cost regardless of demand. Okay, we can look at it, we can see the way they are, just the way it's set up. Some absorb a higher amount, we're going to build more of those products. The reverse of that is when GM and the other car companies all discontinue some car lines. You had some good car lines, but they didn't sell enough. Discontinue. We're not going to carry it. So that's completely legitimate business. I'm sure every one of you, sometime in your young lives, there was some product you liked, you went down to the store to get another one of it, and it was gone. Where is it? Well, I discontinued it. Why did they discontinue it? I liked it. It was a good product. Why did they discontinue it? Because they weren't making enough money on it. They're making money on it, but they can make more money on other products, so discontinue the weak one. In order to increase production, even though another plant in the same firm is better suited to handle that order. What does this mean? It's where we don't have enough demand. We got a couple factories that can make it. Well, this one can do it more efficient, but hey, let's keep it in our factories. We want to keep our people working. Ooh, is that something that goes on in China and India? They're just keeping the people at work? In a way, it's a good idea. Where's it better to keep people working or on unemployment? Deferring maintenance. What does this mean? Just maintenance. What's that? What is maintenance? What? All right, keeping up with the machines, keeping up with the light bulbs that go out, any other machines there. All right, now, we do have, what most companies have, big companies, mid-sized companies, they have a lot of routine maintenance. Do any of you routinely change your oil at about 3,000 miles? How many of you routinely change your oil? Is the oil bad and you have to change it? You just add routine. You know, that's a good number there. We're going to change it because it's too much trouble to find out if the oil is still good for another 500 miles or whatever. That's called planned maintenance. Preventive maintenance. We're going to make some changes. We're not waiting for something to go bad. We know sooner it's going to go bad. Pretty soon, we got a pretty good number there where we figure it's going to go bad. Get out there and make the change. So preventive maintenance. That's the one that gets deferred. If the door breaks, we got to fix the door, yeah, get the maintenance guys up here. If this rug starts to get really horrible looking and whatnot, well, we'll defer that. Paint on a wall, defer another 20 years. No big deal. So the kind of maintenance that gets deferred, this is just an expense. And if I can defer it, I'm going to make the income statement look better. So, again, how would you see if a company is deferring maintenance? How? No, not the efficiency, because you got other factors. What you would do is you do that comparative analysis. What was your maintenance for the last 3 years? And you could figure based upon sales or lack of sales, it would change them. And you can see if it just drops off radically, what's going on? And then, of course, where's the maintenance money going? Careful budgeting. Oh, careful in the first place. The budgeting is done before the year begins. Inventory planning. What's that mean? What's inventory planning mean? What's that? Ending inventory and also a little more detail how much each month. We start in October for inventory. How many of these things are we going to produce each month? We just don't say, I want 5,000 at the end of the year. How much each month and what do we want at the end of each month? That's inventory planning. And where we're going to get those numbers from? Previous year, what else? You better have a marketing department to give you some idea of sales. Now, what's going on with Apple? What kind of budgeting did they do for this new product? Well, new product, first of all, you don't have a previous year. So they got this thing out there that they can't make them fast enough. What kind of problem is that? What's that? That's an extremely good problem. Are they still selling the same price they were 2 months ago? Has the price come down? All right, so when they made that first batch, they had their fixed costs figured in there, in that price. And now that they're selling a lot more than they thought they were, what kind of money they're making? That's disgusting. Talk about oil companies? This guy's disgusting. The amount of money. You lower the price. Usually when you recover your fixed cost, a technique that you can do, don't have to, no law says you have to, lower the price, because you already got your fixed cost. But if there's no competition, guess what? You're charged with the traffic will bear. All right, internal carrying charge for inventory. Okay, this is inside. What they may do is say, okay, you put stuff on the shelf, on the balance sheet, in effect, we're going to have a charge for each month it's there, which that's legitimate to do. Would that charge increase the value of the inventory? Why are you shaking your head? No. Would it increase the value of the inventory? We're putting a charge on it because it's sitting there for a month. Where are we going to put the charge? Now, we're not going to increase the value of the inventory. We're going to put the charge someplace on the income statement. You want to look good by making excess inventory? Fine, here's the charge for it. Period used to evaluate performance. Well, that gets to be tough. Usually it's about a year because people expect their bonuses on an annual basis. Quarterly bonuses, that's been tried, but trying to say, okay, we're going to look at it over 2 or 3 years to see your bonus, that doesn't work so well. Mostly it's 1 year. Non-financial as well as financial variables. Non-financial, that's where quality control comes into play. Inventory buildup, okay. You like these charts, aren't they fun? All right, beginning inventory, 2,000 across. Production, 45, we're increasing production in each one. What should be the effect when we look at each of these scenarios with production being increased on each one? What do you think the effect would be? What do we know about variable costs? Change with the volume. Should be the same. Other things being held equal. What about fixed costs? On a per unit basis, they're going to go down on a per unit basis. And variable costs per unit are fixed. Whatever it is per unit stays the same within the relevant range. Fixed cost per unit goes down if you make more units. All right, so we're going to come down to operating income. Look at the operating income going up. This is because we charge the same price, but the fixed costs are allocated over more and more units. Fixed costs don't increase. So we're getting way up there. So you just take this and apply it to Apple with this latest little gadget they have. What's the number they planned on in the first place? Probably not going to let anybody know that. But assume it was something like this, and they went to here, really making money. Now, if it were in here, and they started out there, now they're about over here, okay, they're only making a little bit of money, a little bit more than they planned. Throughput, super variable costing. Oh, man. Method, which only direct material costs are included in inventory costs. All other costs are treated as operating expenses. So, direct materials, beginning inventory, throughput margin, manufacturing costs, other than direct materials, all piled in down here. The net result, the final net income cannot change. We can mess around with the operating income. That's the evaluation of the manager. All right, absorption costing, variable costing. This says it's pretty good what the difference is. Now, what are the columns across the top? Each one breaks down into 3 pieces. Isn't this fun? Anybody got a headache? You do? Okay, well, let's make it a little worse than you go. Okay. Why don't you get out here without... Oh, no, not that quick. We'll be here a while. All right, so much for chapter 9. Let's get started on 13. Oh. You would like to get done in time next week, right? As well, we got the week after that. Exam, hey! What do you mean review? What do you mean review? You get that with those things I hand out. What do you think that is? No review. All right, this is a real fun chapter. Yeah, it's kind of long. All right, strategy, balanced scorecard. What's a balanced scorecard? No, it's not your report card. And strategic profitability analysis. Oh, doesn't that sound fancy? Yeah, if you're doing this kind of work, you ought to be paid at least $90,000 a year. Don't you think, with fancy titles like that? You are the manager of strategic profitability analysis. Oh, the manager of that? That's $120,000 a year. Got your attention, huh? You'll pay that much? Man, maybe. Strategy. How an organization matches its own capabilities with the opportunities in the marketplace to accomplish its objectives. Commit that to memory. That's the definition of strategy. What are our capabilities? What's going on in the marketplace? We're out there, if we're a blacksmith with horseshoes, and we're the finest blacksmith in 4 centuries, how much business are we going to do? Well, if we go down to Central Jersey, one of the horse farms, maybe we get a little bit of business. Just not there. Thorough understanding of the industry. A thorough understanding of the industry, and this is one thing that accountants have come up short in the last couple of years with some of our biggest scams. Bernie Madoff. They don't ever talk about whether or not the SEC auditors had sufficient understanding of the industry. I haven't seen any statement to that effect, except they did say that in one case they assigned inexperienced auditors. Most of you find out that most of your big scams, you had auditors in there who didn't understand the industry. They're too busy with their damn cell phones and whatnot to go around and find out what's going on. I got no sympathy for the ones who got fired. Once we start talking to people trying to find out what they knew, oh, well, you know, they really weren't up on this, they really weren't up on what the hell were you doing in there auditing? Some of you guys, unfortunately, probably going to find yourself in a boat like that. All this federal money out there. You know how bad, how many of you guys are going to want? You can take a survey. I've been asked by 2 firms already if I want to do audits of government contracts. Guess what some of you are going to wind up doing? They say, hey, here's the job over to this one here. We're doing this government contract. I don't want to do that. Guess what's going to happen to you? Out. Come back to Rutgers, get somebody else. That's where the money is. All that TARP money. All right. 5 acts of industry analysis. Number and strength of competitors. Oh, real estate industry. How many people out there? How many mortgage lenders are out there? Man, a huge amount. Potential entrance to the market. Anybody with money can get into that one. Availability of equivalent products. Well, what's a nice product? Well, let's take Apple with their new gadget. How many companies could possibly produce something that Apple produced? Possibly. What companies could possibly produce it? What's that? Microsoft, maybe. Okay, who else? Okay, there's a few, but not many that could possibly do it. Entrance to the market, well, what you just named, ones that are in the market, if they can come up with it, they get in there. Equivalent products. What's equivalent out there to what Apple's got? Anybody got an equivalent right now? But you know this company's working on an equivalent. Why are they working on an equivalent? What's that? There's money to be made. Why is there money to be made? Because Apple can't satisfy the demand. If Apple's keep making them and they get sold right away, that means there's demand out there that's not satisfied. As soon as Apple makes them and they get stay on the shelf, then it's time to say, oh, wait a minute, that's enough. That market's mature. Go someplace else. Bargaining power of customers. What kind of bargaining power do customers have with Apple? What kind of bargaining power do customers have with Dell? A lot. How'd you bargain with Dell? How about with an oil company? How about with Rutgers? Okay. What are they talking about? Bargaining power of customers. He just gave me a whole bunch of nuns. Nobody's got bargaining power. What's going on? We're talking about big customers. That's what we're talking about. It's talking about somebody who can buy, if you're making a chip, the two of you are making computer chips, and I want to buy, I go to you, I want 100,000 units. What do you give me a quote? Oh, thank you very much. 100,000 units, what's your quote? Now, you know I'm talking to two right back and forth there. So what are you going to do? Maybe you don't know what that one is, or you get whatever, but you know, hey, try to get it all as we can. I'm coming in want 100,000 of these things. That's not this little nickel dime of students walking in buying one at a time. That's what they mean by bargaining power of the customers. Input suppliers. Okay, now this one gets to be a little bit tricky. Your input suppliers. What do you make chips from? Well, let's take an even better one. The electric car, those batteries. What are they made from? What's in those batteries? Lithium compounds. Lithium. So, what about lithium? You don't understand the industry. Where do we get lithium from? There's two main sources of lithium on the lithium compounds. I don't say lithium by itself. It by itself is unstable. What happens if you put lithium in water? What happens if you take lithium about your fingertip and throw it in water? It explodes. So you're looking for lithium compounds. Okay. We got a nice size deposit of lithium compounds. I think it's in a place called Mongolia. Another one in a country called Paraguay. Other than that, there's just small amounts around the planet. Paraguay happens to be good and friends with a country, Iran. Okay, where are we going to get our lithium compounds from? Where? Iran. Okay, good. You see a nice potential problem there? You think the Chinese are going to want to sell us all their lithium compounds? Maybe. At what price? Let's make it as high as we can. You don't like us, get out of Paraguay. They don't like you. Yeah, nasty world we're in here, aren't we? It's global. Before you do anything, always look at global implications. Thanks to all these computers, it's global. Back up 50 years and it wasn't global. Didn't have all these computers. All right, production differentiation. Your ability to offer products or services perceived by its customers. Okay, here's your nasty words. Perceived by its customers. The customers think this is a great deal. Is it a great deal? Yeah, what about these tablets that Apple is making? Do you really need those things? But it's sure perceived by customers as being a great deal. Why do people do that? Some people just got to have the latest and greatest. Latest thing, that's it. Whatever it is, I got to have it. What's the two main characteristics of human beings that make human beings different from every other species? What? Number one, human beings just love to communicate. Communicate. That's why the phones took off so much. Not because they're a great thing, but human beings love to communicate. And now that you got that little thing, what can you do? You communicate all day long, all over the place. The other thing is problem solve. So what do you do when you communicate? Problem solve. Try to figure out who's going with whom and what's going on over there. And you go, well, my class is worse than yours, and blah, 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 blah. Solve all these problems, important problems. Now that you've got that communication capability where you can solve your problems immediately, what do? You're using them immediately to solve these problems. Do you all sell your 1,500 shares of Boeing stock? You get that sold? No, you didn't. No, you don't. Anyone know what I'm talking about? No, you solved some other problem. Okay, product differentiation. What do the customers think is better? And obviously they think a lot of these Apple products are better. Obviously a lot of people think Japanese cars are better. Are Japanese cars better quality than U.S. cars right now? Not right now. But American car companies earned the reputation. They worked hard for it, they got it, and now they got to put up with it coming up short. Brand loyalty. What's brand loyalty? Yeah, you like that brand, you're going to come back to it. Now, automobile companies will do it. Every one of them does this. They all got some very inexpensive entry model. 15, 17,000. Be a tough time putting two of you in, never mind one of me. The idea is to get you into that car, you drive it around, make sure it's reliable, but what you got is quality, and then when you start making more money, you'll come back to them for a bigger model. That's the idea. They all use that strategy. So, all the car companies are pretty much taking a hit on that small model. What they're betting on is that you like that, you'll be back here for a bigger one, and then we'll make money off you. So I come around and they really make money off me, because I wouldn't be seeing anything you guys drive. I got to have something bigger to show you, right? All right, cost leadership. Organization's ability to achieve lower cost relative to competitors through productivity and efficiency improvements. Okay. This is kind of like in a mature industry. Computer industry, you can argue this either way. It's mature, it's been around for a while, but they keep coming up with these new products. Like what Apple did. New product. They'll achieve lower costs relative to competitors. Well, who's their competitor? Not for the current product. What about regular computers? Well, in that area, we're getting competition. How big are computers these days? How big? Yeah, small, yeah. The average automobile today has got more computer power than the, what was it, the spaceship that went to the moon in '69. That's the difference today. What do they keep track of on your car? Mileage, what else? They can have GPS in there. How about your speed? How do they do that? You get a car built, I think, after 2005. There's a computer chip in there. It goes into a black box that records your last 10 minutes of speed. Where did this come from? About 10 to 12 years ago, there was several lawsuits between Firestone Tires, I think Ford Explorers. They were flipping over and they were suing because I was just doing the speed limit and it flipped. It was either the tire or it was the car. No, the car company. You might want to mess with these big corporations. They got people that think up there. let's put a chip in the car that tracks the speed, because we know most people are speeding. Who was the classic person that got caught with that? Who? Who? A couple years ago. Governor of New Jersey. How do they know how fast he was going? It said 91 miles an hour. How did you know that? Was there a cop car following him? No. How did they know he was doing 91? The chip in the vehicle. You get into an accident, and if you're speeding and you say, oh no, I was just doing the speed limit, you make that statement to the police, because they're going to get that chip out and analyzed. Speed limit 55, I was doing 55, and that chip shows you were doing 70. You can kiss a lot of money goodbye. I think after 2005. Automobile companies are out to protect themselves from people who just want to file lawsuits. Oh, you weren't speeding and this happened? Well, how come the chip says you weren't speeding? You guys didn't know about that? Guess what? I did at least one of you a favor then. Because you know better than to lie about a police report if you get into an accident. All right, leads to lower selling prices. We get the cost down, we get lower selling prices. Balanced scorecard to manage the implementation of their strategies. Oh, this is a fun and games thing. It's been around about 15, 20 years. If handled properly, it's nice, but it's too easy for this kind of thing to be abused like anything else. Translates an organization's mission and strategy to set of performance measures. Okay. In a way, you guys got your scorecard. You're at Rutgers, and you've got to take 40 courses, whatever it is. You know which ones you got to take? You got a couple choices. They are your organization's mission and strategy, performance measures. And they get through these 40, whatever they are. Companies do a very similar thing. But we got to break it down. Not as easy as it is here. Balanced scorecard because it balances the use of financial and non-financial performance measures. Okay, we want you to crank out so many widgets a month, but we want the quality to be a certain level also. Can't have more than 2 or 3 bad ones or whatever it is there. Financial perspective. You look at the customer. Why do we want to look at the customer? What's that? More important than using the product, they are paying you for the product. The customers are your revenues. And if you don't have them, you got nothing unless you're cooking the books. All right, so we look at the customer. Why do we look at the customer? Okay, if you're a car dealership, you don't sell too many cars, you know who bought every car. Who's buying these things? How do we find out about something like this? Something like that, you have to rely on customer complaints. How many customer complaints come in? And not just the account, but we got to do some kind of evaluation. This is a good complaint, this guy just pissed off at the world. People do that. I don't know what I'm pissed off at. I'm pissed off at Costa County, but let me go ahead and complain to this guy, tell him what a rotten product he's got, because it won't mark up my Costa County book. People do things like that? Every once in a while. That is when you do fraud investigations. You listen to people bitch, and you get a sense, this guy's got something to say. He's not saying it right, but he has something to say. And a lot of times, especially when it comes to accounting, somebody who's not an accountant, they know something's wrong, but they haven't got a prayer of describing it in accounting terms. So you gotta listen to them and extract till you find out what this guy's really pointing at. So, internal business perspective. What are we looking at on the inside? Learning and growth. Oh, we gotta learn? Want to get ahead? Well, that's what you guys are doing now. You're convinced of that. Or did somebody tell you, just go here, sit for 4 years and you get a nice job? How many of you were told that? You were? She put her hand up. So you. You were told you sit here for 4 years to get a nice job. No? Well, why'd you put your hand up? Well, your hand was up there. I saw you doing it. All right, learning and growth. The computer world. That world is something. Shows you right there. I mean, that's. I don't think there's ever been an example like that in the history of mankind. Not since first man 200,000 years ago invented fire or whatever there. But that's been phenomenal. What do you got to do with that? You got to keep learning and stay with it and everything else there. When I say what does the system do, what can you do with systems with all these little gadgets you have? What can you do? If you're given access, you can use, most of you got the gadgets, you can log on and look at cost information if you're given access. Doesn't that make you feel good? You can do that with cost information? How about this one? Your boss is going to expect you to do it. You're home, I don't care where you are. Look at that data and give a report back. Yeah, but it's 8 o'clock at night. I just finished dinner. I need to report now. And you can do it because you got the gadgets. You like that stuff? Yeah, that's one of the headaches of the world, today's world. Especially since it's global. Maybe 8 o'clock here, but what time is it out in Hong Kong? They're starting there, okay. Well, you get these, what do you do? Tell your customer over there, well, you got to wait a couple hours till my guy wakes up? Oh, all right, whoa, wait a minute. We can't do that, not if you want to do business. It's a global world, global business. Answer for a second. Profitability of the strategy. Okay. Profitability, are we making enough money? How much is enough? It depends. If you got a number of things that make it 8, 10, 12%, why are you hanging on to the things that only make it 4%? Most objective measures in the scorecard. Objective, and that's usually dollars and cents, how much is coming in. The other three perspectives eventually feed back into this dimension. So no matter what you're doing, sooner or later it's coming back to money. And that's why the famous saying in investigation is follow the dollar. Anytime somebody starts ranting and raving about something, how are you making money on this deal? Oh, you're one of these do-gooders that works for nothing? There aren't so many of them on the planet. How are you making money on this deal? Oh, you're not making any money at all on this. You want to say that to me? Usually not. I'm out of making money. It's all going to feed back to that. Customer. Targeted. What do you mean targeted customer? What do you mean targeted customer? Any of you guys getting any kind of junk mail from down and look at the new cars or whatever? You guys get that? Why do you guys get that? What's that? Why are you targeted? They figure you're going to graduate in a year or two and you're going to be able to afford a new car. And you're going to want to get rid of the clunker you have. Oh, you guys are fertile ground for that kind of stuff. I don't get too much of that. What do I get? Here's your pills from Canada or wherever. Cut rate pills. So that's how they target you. Okay? All right, internal business perspective. Focus on internal operations, create value for the customer. Now, you say create value for the customer. Who wants to try to explain what that means? We're going to make a product that the customer perceives as valuable. Apple, the tablet. The customer perceives it as value. They're willing to part with their money for it. How much money are you willing to pay for it? So, we want to go around the company and we want to do things that the customer will pay for. Well, if you think about it, why would you spend money and time on something that people don't want? Why would you do that? Well, the only reason why you do something like that is because You've either got something new, or you don't realize that people don't want it, or you're a little bit behind the curve. 3 sub-processes. Innovation. What's innovation? What's innovation? Coming up with something new. Look at the tablet. What's after the tablet? Whatever that thing is. What's next? What could be better than that thing? What's that? How about one you put on your wrist and you just have it on your wrist there? You don't have to carry it around with it rests on your wrist, huh? Better yet, we got a habit of visors right there. All right, innovation. The saying is, in order to prosper, a firm must innovate. In order to survive, a firm must cut costs. So where does that make the accountant look like? What's that? The accountant's the one's got to show you how to cut costs, because a lot of these innovators, they don't understand that, and they go bankrupt because they don't understand that. Operations. What's operations refer to? Think operating income. What's an operation? It's what the company does. What do they make? You always think of operation, something going on, the operation on my hand. You look at that, that looks better there, okay, yeah. Got a whole bunch of cream to put on it and how to massage it, yeah. Waiting for the bills. Post-sale service, what's this? What's that? Post-sales. That's your warranty type work. This was not too big after World War II, but it got bigger as we got more lawyers around, did more suing. And now if you buy a new car, they're going to say, we've got this basic warranty, but for an extra $500,000, you can get an extended warranty. $500,000, whatever it's going to be, something like that there. Would you take that extended warranty? Give me a little tip. If you got the money, take it. Because when you go to resell the vehicle, that figures into good sales for the buyer. The buyer knows you had that, any problem, you would have taken it down. And if you got the extended warranty, that's what you're going to do. The biggest headache with a used car is, well, what's wrong with it that I don't know about? So you got the extended warranty, here's over here, this person probably taking care of it, and if you pay $1,000 for the extended warranty, and there's anything wrong under the warranty, what are you going to do? You're going to get it down to the dealer. So if somebody buying that car, they're pretty assured that that car is totally functional, no problems. All right, learning and growth perspective. Capabilities organization must excel. Boy, well, what does Apple have to excel in? They got to do something that Microsoft is not doing, that Dell's not doing. Otherwise, what's going to happen to them? They're going to go under. What about oil companies? What do they have to do? Keep the prices high. Why do you think oil prices are high? What? What about all those people over in China and India and Latin America that now got our dollars? They want cars, they want gasoline for their cars. What about them? That's what the oil companies are doing right now. They're selling a lot of gasoline in those countries. Why? Hey, they'll pay more. They don't bitch at the oil companies. They don't get threatened with lawsuits every time you turn around. They have all kinds of people on the news saying these oil companies are bad. Who would you deal with? Well, they're glad to see American oil companies. What? Don't they use what kind of oil? Oh, comparatively, yes. Yes, except for one little thing. With this global economy, we're seeing a shift. The demand in China is growing. The demand in India is growing. The demand in Latin America is growing. So you're absolutely correct. Except it's growing a lot faster there than here. and we'll pay you more for the gasoline. And the company says, well, wait, let me see. The pipeline was shot down. You want a lease for offshore drilling, you got to wait 6 months to a year. We can't drill in Anwar. Every time we turn around, somebody's suing us. They haven't been allowed to build a refinery in this country in over 30 years. What are they going to do? Come on, it's a no-brainer. You keep telling somebody you're worthless and I can't stand you, what are they going to do? Try to be nice to you? Come on. And besides, the main strategy of those one extremists is to get the price of gasoline up to $6, $7, $8 a gallon so that you'll be glad to buy an electric car. That's one of the strategies. If it goes high enough, people will buy electric cars. You don't have to worry about it. That's a strategy. What's that? We have it the best on the planet. Well, can't compare to what? Jersey, for all its shortcomings, we got the best on the planet. By the way, that's probably why a lot of people are here from other countries. New York has got to be better where they're from. What does that say? I don't mean to insult you, but that's not what it says there. So, if you're here, I mean, well, why are you here? Oh, you know what this country does more than any other country? Education. We're the only country on the planet that can mass produce education. What's that? Either way, we've got the capability of doing it. Most countries don't have a prayer trying to run this kind of education. Not on our scale. We get 57,000 students at Rutgers. What's that? I don't know how many. Well, we get 57,000 students, and by 2013, September 2013, they want 5,000 more. We're mass producing them. Well, you got more students in colleges in this country than you have in Japan, India, and China combined. That's because we got so many colleges out there. Whatever. Okay, what page are we on here? 11. Yeah, this time next week I'm liable to have my 7th grandchild, so. Don't blow it. I'm not to be in a good mood. Don't come in here and piss me off. Go ahead.
Thank you. Yeah, I was getting killed with something in Europe like that, especially England.